Yes, thank you guys for joining us live here. See, we're well represented across the country. We'll be talking about markets. We'll be talking about underwriting, specifically underwriting markets, underwriting locations, and underwriting the deal specifically. So happy to be diving in on our thought process, how we look at deals, from experience, good and bad, through seeing the market, what it's doing, and especially in 2024. So, I think right now, one of the most important things to evaluate when looking at a deal is protecting your downside. And that's probably why we haven't done a deal yet in 2024. We're 7 months into the year and we still haven't done a new deal. So we are staying, if you've been on some of our other webinars, that's, not for lack of trying, but it's really helped us dive in on our current systems and processes. And you'll get a kind of look under the hood on how we're looking at markets. And, we'll talk about market analysis, location analysis, and deal analysis. These are the three main points for tonight's webinar. You guys, anything you see here, feel free to jump in on the chat. If you have any question about any points on here, this is open forum. If you guys are in the Facebook group, you guys can put questions there too. Stop us and we'll dive in deeper on anything. So I'll first take us into market analysis. So this is high level, what we're looking at. We were shouting it out here on the webinar, Indianapolis, DFW, Frisco, even McAllen. Those are all markets that we've looked at. I quickly told you, New Jersey, that's probably not a market that we're going to, if we get a deal sent to New Jersey or Boston, where Mina's at, it's going to be a quick, pass for us. Because we get sent so many deals, it's important to have, really a buy box. Elevate specifically, we're in multifamily, but we're looking at A-class deals, B-class deals, C-class deals, build to rent, and then markets where we have these kind of thesis on the markets that we're looking at. So we're looking at strong markets that have population growth, income growth, home value growth, declining crime, super important here, job growth. Ideally, the market that you're looking at hits all of these. Maybe the income isn't as growing as fast as some of these other items. So you want to weigh in all of these together. Some questions to consider: how did this market perform during previous recessions? Was it affected at all? Was it hit very hard? That'll show kind of market resilience that can help you in underwriting, your downside cases when you're what you call stress testing a deal. How concentrated is the employment base? Does it have just one major tech, hub? Silicon Valley, very tech heavy. Certain markets in Oklahoma, very oil based. You don't want to be reliant on one major employer or one major sector. So I'll hand it over to Nick to see how that actually looks like numbers. This is great to say, in theory, population growth, income growth, home value growth, but how are we actually tracking that?
Yeah, so I mean, we'll look at the cities. We'll drill down to each city into the market that we're looking at. So up on the screen here we've got Fort Worth, Arlington. Those are two cities within Dallas Fort Worth Metroplex, and then we've got Rapid City, South Dakota, and then we've got Baltimore, Maryland. So just 4 examples of cities within markets. And then we've got a couple of metrics up here that we're going to take a look at. Population growth, obviously you want to see population growth, more people, more demand. Median household income, just pretty crazy to actually see from 2000 to 2021 some of these income levels and how strong inflation has pushed some of these metrics from where they were in 2000. So across the board, you'll notice the income level is well above 40% over that time frame for these three or four cities. Then obviously, we'll look at median house or condo value over that same time period. That's just real estate appreciation, and that's typically driven by more population growth, more job growth, et cetera. Then we'll also look at crime indexes to make sure, that these areas are decreasing in crime reports and crime incidents. Obviously, we want to invest in the safest areas today, but if there's a trend that the area is getting safer over years, then that might be a good opportunity to scoop up a good deal at an attractive basis, because some other groups aren't possibly, looking at that data. They're not looking at the trend of the crime. They're only looking at it where it is relative today. So we'll look at, the crime trend and make sure it's decreasing over time. Job growth last 12 months, that's obviously pretty important too. That gives you a snapshot of the current growth of the employment base in that city. So, I mean, on this list, the one that really jumps out here is just Baltimore, Maryland, with declining population growth over that last decade there. Even though that they saw appreciation on the house and condo values, and also median household income, that's probably not an area that we're going to invest in, simply because, the population is declining and the job growth is pretty flat as well.
These crime reduction, is this per, like, just per incident, right here, this 131, 137, minus 1434. So this is saying 14 more crimes happened, or I guess it's just,
No, I don't think it's specifically one for one. It's more of an index, and it values, it looks at the population and crime, so it's per capita crime. So, a higher population city is gonna have typically higher crime, but on the per capita, that's what that number is measuring.
gotcha. So
So,
that higher this number, the worse the crime over here on the index score.
correct.
Gotcha. Yeah, so I think that's interesting. You can see Rapid City, where we have our assets at 278 unit. That was a picture, the front picture. It's interesting to see that the crime actually went up slightly. Still, if you look at Baltimore, Baltimore's crime decreased relative to its index. But I walk around Rapid City, especially where that apartment is, and feel pretty
Yeah.
safe. I think,
That drives home the importance of not just, city and market analysis, but also a very specific location and neighborhood analysis, where our property in Rapid City is in a really great location. We've driven it. We got the feel for the area. It's on the southern portion of Rapid City, much higher income levels, lower crime as a whole. And then there's parts of Rapid City where the crime is higher, and that's probably what that's capturing, where the majority of residents live.
yeah, so we'll be diving into that location here in a slide or two. So what are we looking at here?
All right, so I mean, this slide's looking at, well, we've got a couple slides here. This first one is just looking at non-farm, let's see, payroll, or not payroll. This is just employee base for Dallas Fort Worth MSA. So
Job growth.
yeah, so you'll notice during the COVID 2020 dip there, that number dropped quite a bit. And the reason we're showing this is on the next, maybe not the next slide, the one after that. This is Kansas City. The one after that is Baltimore. So really just driving home the point that the employment base really, it's taken a long time to recover. If you look at the peak in the past, from 2010 to 2020, for each of these cities, you'll notice Dallas Fort Worth was around 2,800, and then it dropped. Everyone dropped during COVID, That was a crazy time, but it's recovered quite a bit and it's only increasing. Same thing with Kansas City, similar chart pattern there. Um, took a little bit longer to recover, but and then you'll notice Baltimore really it dipped quite a bit and it's just now reaching, that employment based level. So it's remained relatively flat over that period. So it's definitely, something that you don't like to see. You want to see accelerated job growth and increasing job growth over that time. Um, but this is just a snapshot of stuff that we're looking at when doing market analysis.
Yeah, I think this is really interesting too. Like, yeah, it's great to see this population growth, and really, like, if we're looking at these kind of past recessions, what did the bounce back look like from each one? How, '08 took KC quite a while to bounce back, but COVID, it bounced back pretty quickly and surpassed it, like we're talking about, and Baltimore still hasn't recovered. And I'd be interested to see some of these other markets, like even some that people put in here: Houston, McAllen, Denver, New Jersey, Tampa. Where can people find? It looks like this is at
Yeah, Bureau of Labor Statistics, St. Louis Federal Reserve. You can just Google that and then type in any city that you want to see here.
just Google fred.stlouisfed.org, I guess, right
Yeah,
here. Yeah, this is good market indicator, strength of market. That this is free at fred.stlouisfed.org. Yeah, I think I'll be taking a look at some of these other markets too. And this is like, if we do get sent a deal and like a Corpus Christi, or like even like a San Antonio, or somewhere where maybe we haven't done a deal, but we know it checks a box. Something else we didn't talk about here: business friendly and landlord friendly. One of the reasons why we're not buying in California or the Northeast. But if it's in somewhere like that, and this is a quick resource to really dive in and look at those numbers. You want to be taken off with a tailwind, not taken off with more resistance. And a good market can help you really implement your business plan, and a bad market can make it really hard on you to turn around a certain asset. So
yeah, we're really just trying to quantify demand right now and understand, all right, like Brian was saying, are we going to be fighting against the market with our business plan, or are we going to have tailwinds pushing us forward? And we always want to be in that scenario where we're not fighting against the market and we're riding the demand.
it also helps too when you're buying in these stronger markets. You're in buyer. So when we do these business plans of 3, 5, 7, 10 years, you want to have an idea of who your end buyer is. And when you're buying in these stronger markets, and having these trajectories, the people that you're going to sell this deal to, it opens up a lot more. So your exits are a lot easier, when the market is right and when you've completed your business plan. I would say an interesting market is like Northwest Arkansas. That's a market that I'm in currently, and a market that we're invested in. And we feel like we're coming on this vertical here where its populate or its job growth is hasn't skipped a beat here, and we're kind of on the emerging market trend there, where 3 or 4 years ago people would say, I'm not investing in Arkansas. But now people are becoming more aware of this hidden gem of a market. And even like Rapid City, South Dakota too, it's becoming more aware to these institutional type buyers. Is the recording going to be sent out after this call, after run? Yes, absolutely. We'll be sending this recording out to everybody who registered. It'll be available in the Facebook group. Mina's also going to send the full recording, personally email that to you guys all. So no problem if you got to jump. We'll be sending out the recording. Okay, so yeah, so that's high level market, what we're looking at on the markets. What we're gonna look at, something we didn't really we talked about it in the beginning, employer base, we're looking at those larger employers. And what's driving the economy. So we're gonna dive into location analysis here. So we're talking about, um, again, what we looked about here in Rapid City, we're diving in specifically on the specifics of what part of Rapid City, what location. Baltimore, Maryland, it's not a market we would invest in, but I'm sure there's really nice places in I'm sure not all of Baltimore is this, high crime index. So this is looking at neighborhood, street level, school districts, census block, home values. That can really change in a 1 mile radius. It can change in a 3 mile radius. Someone before, yeah, as we dive into this location analysis, before we kind of get into here, someone asked, isn't it a bad idea to own assets concentrated in just a couple of markets that seem to look attractive right now? So I guess, that question, there's kind of two parts of that question. Own assets concentrated in just a couple of markets. We're pretty broad on what we're looking at. I would say we're market agnostic. We're looking at Cincinnati, Lexington, Nashville, Tennessee, Macon, Georgia, outside of Atlanta. We've looked at deals in Jacksonville, Florida. And then I guess the second part of that question is just look attractive right now. So the bad case is, yeah, when you have, we're investing in Dallas, so is everyone else. It is very hard. People are still buying in Dallas, and we think people are overpaying in Dallas. It's one of our target markets, but people are willing to overpay in Dallas because of how strong the market is and because of how strong those numbers. It's institutions that are putting a lot of money back buying these Dallas assets that are okay with, lower returns. And I think it definitely makes it hard to, do deals in those markets that look attractive right now, but you want to see that trend. And something that we're doing too is, yes, we like Dallas, but we're looking at markets outside. We're looking at submarkets of DFW. We own assets in Weatherford, Texas. Someone may not know about Weatherford, or someone may not know about Mesquite, or someone may not know about Burleson, or different parts of those. So we are looking at the markets surrounding that, and that kind of goes into this location analysis here too. If it's not, we're buying on what makes sense today, and Nick will talk about that too on the underwriting. So, you don't, if it's not attractive right now, you're almost taking a gamble on if it's not, attractive right now. Maybe it's not, but we would want to know why it's not, why it's not attractive right now, and why do you think it'll be attractive? If it's not super attractive right now, why do we think it's going to be super attractive? Is Walmart building $1 billion campus right next to it? Well, that's probably good. That's a good indicator that it is going to be more attractive in the future. Is Panasonic making a $400 million data center in the area? That's a good indicator that it's going to become more attractive. We're looking at what kind of investments outside of just multifamily are going into the area. So that's going to help, paint a picture of future growth. So those are definitely things that we're looking at too when we're exploring the market. For deals that you're underwriting that fall below 80% of the asking price, are you guys still putting in LOIs on those? I'll let you answer that, Nick.
Yeah, I mean, I can take that. I mean, absolutely. If we like the market, we like the location, we like the deal, you know, it's the asking price is what the seller wants, right? Sellers need to realize that this is not a seller's market. This is a pretty neutral market, if not a buyer's market. So, buyers are more selective right now with deals. So the bid ask spread, like you mentioned, is around 10 to 20%, and we're we're still sending out LOIs on deals regardless of, what the asking price is, because in a lot of cases, these deals are just not gonna trade. And we'll come back around, we've already underwritten the deal, we've already offered on it. And, the broker and the seller realize that we're familiar with the deal, and we like it at this price. And if it doesn't trade, come back to us. That's happening a lot right now. So definitely think, submitting LOIs at the price that makes sense is fair game.
Yeah, absolutely. Yeah, we are letting them know, sometimes a deal will be marketed, they don't get any interest, it goes out for 3, 6, 12 months even, and they're starting to come back to the people that expressed interest. Hey, I know you wanted 32 million. This deal makes sense to us at 27 million. Let us know if anything, happens, and then they'll come back to those people. So we're definitely not sitting on our hands right now, even though we haven't done any deals this year. Staying active, tracking these deals. What size of deals are you looking currently overall and in DFW area? 100 units and up, I would say. DFW, if it's a built, larger unit, maybe we'll look slightly under 100. If it's a really good deal, we're already managing, 1,200 units in that area, so it'd be pretty easy for us to do a deal. But we really like 100 units and up, just for the economies of scale there, and for it to pay for someone to have, a in-place leasing agent. But some of these units are bigger if they have attached garages, there's other income. Sometimes they can be slightly under 100, where it makes sense on a gross income level. But I would say 100 is probably the threshold, depending on the market. Great questions, keep them coming. So just quickly on location analysis, we're looking at surrounding jobs and retail. Crime reports are super important. Home values, census block, independent school district. Crime reports, this can make us back out of a deal if we find out some information, on the crime. But by backing out of a deal, that's more of like, hey, this is where, before we even submit LOI, we're going to let a person know, hey, we're interested. It's kind of what I said, you want 30 million, we're probably at 28 million, and then they may say, hey, that might work for us. And then we start looking at, okay, these location analysis, and we're looking at this, maybe the numbers made sense at $28 million, but then we're looking at crime reports, and there's, crime going up through the roof, or maybe there's a prison right around the corner, or, some of the home values and surrounding income near the property doesn't support the increased rents that we have on the project. So these are all super important right here. This is a snapshot of the market of a 200 unit townhome we closed in December, called Madison. Now it's called Louis at Overland Park. Overland Park, Kansas, a really exciting market the more we dove in about it. It's actually one of the more institutional markets in the country. It's a top 50 metro, and that's because of the incredible diversity of job or employers in the area. There is not one market, there's not one specific market that's represented here. It's not just oil, or it's not just tech, or it's not just retail. There's a ton of development in this Overland Park area. Yeah, Tyler lives in Overland Park, Kansas. Yeah, it's a great area to live. Yeah, a lot of professionals are there. If you're in Kansas City, Kansas City meets all our market check boxes, and then Overland Park, Kansas meets our micro check boxes. You'll hear me talk about it. Starbucks and Crumble cookies. You don't see a Starbucks and Crumble cookies next to a C-class rundown property. Someone's not paying $10 for a cookie if they're paying $900 for or under for rent. It's these employers do just as much market research as us too. So it like a Whole Foods is looking at the market before they invest $50 million to come in and put their employer there. That's not to say we're only buying if there's a Starbucks or, Whole Foods next to it. But if you have an A-class deal, you better hope that you have some of these, higher end retailers. Yeah, Louis knows cookie stores drive apartment values for real. It's interesting, they're doing that street level data, because someone's not going to drive 20 minutes to go, get a cookie or go get a coffee. They want to be right next to it. So they're looking at this neighborhood level. So this gives us a really good indicator, especially for the A-class deals. And for the C-class deals, we're not specifically looking for Whole Foods or for Starbucks's or for, some of these other, a Louis Vuitton store or Nordstrom Rack. We're just making sure that there's not a lot of high crime there. C-class, we understand that it's not going to be A+ school district, but at the same time, you don't want risk of getting, assaulted, in that corner. So those are the things we're looking at for those kind of sub-market, micro market. Home values, this is important. You can kind of see what kind of neighborhood supporting that, what's the home value trends for people in the area. Yeah, Louise, piggybacking, Walgreens has a big real estate research department. Yeah, Walgreens, same thing there. They're doing, high level research on not only, they're doing the same thing. They're looking at a market, but they're looking at the micro level of an area. So they're not going to put a Walgreens where, someone only wants to pay Walmart price, someone would rather go to a Walmart than get a discount, or even a Dollar General. Someone's gonna, when you go to Walgreens, you're paying a premium because it's quick and it's, what you're gonna get there, aside from the pharmacy. So that's great. Yeah, great piggyback there, Louis. Someone asked, when does a property start slipping into D class? What would you say is D class, Nick?
Yeah, I mean, D class, probably a combination of multiple things.
Besides crime, he says. Well,
Yeah,
crime is a number one. I would say crime is definitely the number one for
yeah,
D class.
yeah, crime's big, if your income levels are below the area median household income, that's probably an indicator that you're gonna be either C or, honestly, I've never heard of a D class property. I kind of just cut it off at C. But yeah, if your property has significant deferred maintenance, there's a lot of down units, etc. It's probably going to be a C- or D.
I've owned OZ. I have owned some D class properties back in my start. I thought they were C class, but some of the rents were $395 when I took them over. So you can imagine, when I was walking those units, there was mold in the property. The residents didn't want to report their mold because they thought if they reported that the rent would go up. They were happy just paying the cheap rent. You had stove tops missing. It was, these were smaller multifamily that I've already exited, but I would say, the rent levels is probably a good indicator of if it's a D class too. What's the current rent at, if it's below 500 and below, some of the Section 8, it's not something I would not say I'm even close to being an expert on. They have set rents too. I don't really understand the Section 8. That's almost a niche within multifamily. But I would say crime, income levels lower than what supports a rent. If your income level is basically what your rent is, you don't have much to afford more than your rent. If the median income level is close to minimum wage or around that 1 mile, 3 mile radius, it's probably, a D class, I would say, D class area.
And
So
the only
this
other
is,
thing I would add to that is location as well. You know, crime kind of goes into that, but just looking at where it sits, you can be in a D location. And then the rest, what you guys mentioned, deferred maintenance is huge, and the amount of work orders not getting done. And then obviously the rent.
yeah. So home values, we're looking at this. Do you look at like what radius do you set on home values when you're looking at a property? 5 miles, 3 miles, 1 mile? What are you looking at, Nick?
Well, this is just, I believe this is just a zip code snapshot for home values. And honestly, the home value stuff, it's probably falls on the not as helpful category because, home values have been appreciating in almost every submarket at a pretty crazy rate. Although we just, we don't want to see a reduction in home value price because that typically is because of high crime, decreasing population growth, et cetera. So, that's usually a result of those two factors. But yeah, this is just a zip code snapshot of the median home values. I believe this might be for Overland Park. Yeah.
So you're looking at the zip code level, and then I guess for income, household income, are you also, I guess, also looking at that? I guess that's the one where I see your mile, 3 mile radius is on.
Yeah, that one's typically that one's pulled from several sources. CoStar's got a nice 1 to 3 mile radius for median household income. And then HUD has published county median household incomes too. So we'll look at it both ways.
Yeah, I like looking at the household income. I think that's one of the more important ones,
Yes,
household income.
definitely. Yeah, because I mean, if you got a low income level for that area and your business plan, you're banking on some pretty heavy rent bumps, you're probably gonna result in, some more economic loss, whether it's physical vacancy or bad debt tenants can't afford. So, your bad debt piles up. So that's definitely something that we hold a lot of weight towards is the median household income.
Yeah, so here's a more deep level. What's this website right here?
This is a snapshot of our asset in Overland Park. Let's kind of put a blue square around it. This is just a 3 month crime map for Overland Park. And I believe I pulled this just from the Overland Park police website. Cities typically have crime maps where you can just put a time frame and just see, reported crimes over that time frame. And really, it's actually pretty great to see that our property had essentially 0 reported crimes over that time frame, while other locations are flagged with crime. So, I mean, there's not, I don't believe there's one specific website where you can do this, maybe LexisNexis or something, but I typically just go to the city's police department and they typically have a lot of data on this.
Yeah, and this is diving in more to the types of crime that are happening. It looks like here you can kind of see looks like shoplifting or
Yeah, and
assault and
shoplifting stuff over there. That next slide is actually, so this is driving home the point that you really got to get specific on your location. This is two assets and locations in Arlington, Texas that I pulled. They're pretty close to each other, probably 2 miles or so apart from each other. And this is the reported crimes over basically a month at each property. So you'll notice the one on the left has, I don't know, over 20 reported crimes, a lot of assaults, and intimidations, et cetera. And the one on the right has 1 reported crime over that same period. So, the tenant base on the one on the left is probably going to be a little rougher around the edges. And that's just something that we're gonna look at before we put a, deal under LOI or contract.
Yeah, and this is not to say "Hey, I'm not gonna buy a property right here with this crime. It's to say I probably can't get 5 to 10% rent growth if this is happening consistently in the area. Maybe it turns around, but I can't underwrite that. This area looks a little bit better, and like you said, knowing what you're getting into before you get into, as long as you can underwrite that. And AP talked about, yeah, you want to get into the underwriting here, so that's exactly what we're about to do. Can you talk about how rent comps play into our underwriting? So we'll dive right into that. We talked about this household income. This is super important, so not to glaze over it, but this is really important to be looking at 1 mile and 3 mile household income. School districts, which we talked about. This is a school district in Madison Overland Park. Great feature. So we'll get into the actual underwriting here for the last portion of the webinar. So really looking at your asset downside protection. So when we get a property, we're looking at what's called the T12, and that is showing a snapshot of how the assets performed over the last 12 months. Over the last 12 months, what was the peak economic loss? Are we seeing a bunch of move outs 1 month? What happened during that month? Will we be able to service our debt if that happens again? We're figuring out why that happened, and two, what happens to our debt service coverage ratio if that happens. And something that you can look at is break even occupancy is a good number to look at to help determine that. So break even occupancy is how many units can move out before you're breaking even on on your expenses. So some of your properties that you want to look at is what's the break even occupancy? Is it 80%, 70%? Able to service our debt? A lot of these questions are we able to service our debt? We're seeing this across the board. Why it's important to get fixed rate debt right now more than ever. So exactly what your debt is going to be. It helps a lot in underwriting. You're not making a bet on future, increases or decreases. How much reserves funded at closing should cover these worst case scenarios. How many units are achieving year one underwritten rents? You want to make sure you're not just coming in and saying we're going to increase $150 day one. That's going to be a gradual effect, just because your neighbor, the apartment across the street is renting for $200 more a door. That doesn't mean we can come in and just say, hey, we're taking over July 1st. Everyone now pays $200 more than you are right now. That's going to happen as units become vacant. We're looking at leases. When do leases expire? This is something that we're doing in due diligence. Two, really fine tuning that. Your NOI growth over the hold. Exit caps, super important. That will, can affect your numbers a lot. What do we think the exit cap rate is going to be in 5 years? Basically, where do we think the market is going to be? Basis, sales comps, rent comparables, and replacement costs. We're looking at a lot of A-class deals right now, and we really are looking at the replacement costs. If we can buy already delivered, already stabilized property at what it costs to build, that's a really good buy as far as protecting our downside. I will let you, Nick, dive in here to take a look at the T12 analysis.
Yeah, so T12, like Brian mentioned, that's just the trailing 12 months of operations. So we're just looking at how the property has performed over the last 12 months. So we can really kind of put it in a box and say, all right, this is what they did. What do we think that we can do? And what are we going to change? So, I mean, for this example, this is a 104 unit deal. I believe this one was in DFW. And it looks like, if we're looking at the total economic loss there, they peaked in January of 2023 around 16%. That was mostly due to higher vacancy there. That's typically a slower period. Winter is typically a slower period for leasing season in DFW. That might be the reason for that. It could be several other factors, but it looks like they, improved their occupancy throughout the year. And it looks like they're, the other thing that jumps out here is their bad debt seems really high. At least the max does at around, that 7% or so in August of 2023. Something happened to there. They had a big bad debt write-off in August of 2023. So I mean, that's something we'd bring up and ask, what happened there? Was that just one resident? Was that multiple residents that weren't able to pay? And we'll look at the total income trend here. It's gradually been at least it's been increasing over these last 12 months from $172,000 effective gross revenue all the way to 177 for December 2023, and it peaked around that June to August area, June to September area, most likely due to stronger leasing season and lower vacancy. And yeah, we'll just keep going down here, and we'll look at operating expenses. I'm not too concerned about operating expenses on a monthly basis, as we're typically gonna just underwrite our own operating expenses, but we'll definitely keep an eye out on per unit numbers for payroll, contracts, R&M, all that here. If they have really high operating expenses on a per unit and total percentage basis, we'll essentially just take a new snapshot of what we think we'll be able to operate the property at. And going back to another question earlier on in the webinar, someone mentioned, concentration of assets. I think it could be a good thing actually to have, some concentration of assets, because that market well, what you can operate it at, you have the numbers to prove it. So, a lot of the markets that we're looking at, we already own there. So that gives us an advantage when we're underwriting deals. We can, layer on our existing operating expenses on a lot of these properties that we're looking at and show, all right, we're going to, improve R&M, we're going to lower contracts because we have it at these levels at these properties. So really to teach well, it tells the story of the property. It tells the story of the manager, and really tells the story of where you could take the property. All right, so some downside tests, that we'll look at, and this is really not something that we'll do on like an initial underwriting. This is more like when we're serious about a deal, we're going to stress test it to make sure that we're in a good position in a downside scenario. So the first test that we typically run is just what happens if we reach that 16% peak economic loss? Are we able to service our debt? And in that scenario, that's the one on the far left there. We would be, it looks like, yeah, we'd be cash flowing still and able to service our debt, which is good, including that principal payment. So it's not just interest. We look at it as a amortization schedule as well. Even if the debt is full interest only, we still want to look at it as, what if it wasn't interest only? Or are we going to be in a situation where we're short on our debt service? And that scenario one, we'd be servicing it pretty handily. So there's some good cushion there. In scenario two, we would stress it a little bit more with higher physical vacancy, reaching that max combined economic loss of 22%. Something's got to be going pretty wrong for a property to reach that level. And in that scenario, we'd still be barely servicing the debt with a 1.01 debt service coverage ratio there. So even in that, pretty bad scenario where we're reaching that high physical vacancy, high bad debt, we're still in a decent position because we're able to service our debt. And then, in a very severe downside scenario, looking at, the cash flow here, if we reach that 22% economic loss again, and we have zero rent growth on our leased rents, that's typically not something that we're going to see. We're going to be short $90,000 roughly for that year. So in general, we're going to look certain deals certain ways. And if a deal has a higher risk factor and has a higher chance of hitting these, downside scenarios, we're going to bake in some operational reserves to protect us to avoid any future risks and capital calls and such like that. So
Yeah,
that's,
Richard said it's pretty hard to read this slide. But yeah, I mean, Nick pretty much laid it out there here with what we're looking at. All the income assumptions and all the expense assumptions. This is end of year month. We're looking at economic vacancy, net rental income, all the controllable expenses, total operating expenses, and then your loan down here, and what that looks like if what happens at these different economic vacancy levels. That's factoring in physical vacancy and bad debt. So here we can see the different scenarios of what happens if vacancy goes up and bad debt goes up. And if you want to email us, we can send you a copy of the slides too. Jason asked, has it been challenging for your team trying to keep a consistent growth in net operating income while expenses steadily increase as well as insurance? So the question there, I guess rephrased, expenses steadily increasing. Yeah. Taxes and insurance have gone up through the roof, more in some markets. Texas markets are getting hit pretty hard with insurance. We're combating that by fighting the taxes. We appeal all tax increases. Insurance, working with insurance providers to have blanket insurance when you have a certain amount of units. But the NOI, yes, absolutely, it's tough. So you can push on income, but you have to balance that with trying to find room to stabilize expenses. Some of those uncontrollable, but like insurance and taxes, and hopefully you are underwriting correctly to assess those, but also pushing on net operating income, finding other ways there too. I don't know if you guys had anything else to add there on trying to keep a consistent growth in NOI while expenses.
Yeah, I mean, I would say you really got to be able to focus on operations and maximize the NOI. It's not just as simple as raising the rents, right? Especially in some of the markets softening with rent growth. You got to know how to do other income and really squeeze everything out of it. Add internet bulk packages. We make a certain profit share on all our renters insurance and everything else that Brian mentioned as far as keeping the expenses as low as possible too. But yeah, you gotta heavily operate it for sure.
Yeah, value add is big. What are your thoughts on PFCs to get tax abatements for percentage of affordable rent units? Seeing quite a few of those around Texas. We are big fans of that. We're trying to implement, Texas is a perfect place to do that, and we're working on that, implementing that on, a good portion of our portfolio in Texas. We successfully did it on one of our assets in South Carolina, Columbia, South Carolina, and working on a few of ours in Houston and Dallas. So it definitely makes sense, if you can get it approved, which will help, your tax situation. So that's something that we've had a lot of time to be drilling in on and executing on. So
Yeah, I mean, it's a highest expense on all our properties. So I mean, if you can get rid of that, absolutely.
it probably depends a bit on the follow-up question on that tax abatement. It depends on the class of property, is what he's asking. Does it depend on the class of property?
Yeah, I mean, not every single one's gonna fit the bill for tax exemption. I mean, the best ones are the best ones that fit are typically gonna be newer, and the ones that typically get approved right now are gonna be newer construction ones, in better areas. And really, the city or the county wants to bring in some level of affordable housing. So you're trying to create a win-win situation where you get some tax exemption, but in exchange, you're bringing, you know, typically 50% of the units go to some level of affordability, whether it's 80% AMI or 60%. Every single deal is structured differently. And we're definitely getting familiar with all of it now. But yes, to your point, it definitely depends on the class of property.
So here we're looking at unit mix analysis. I guess if you wanna dive in more on this, Nick, this is taking a look at, this is all units on the current property, right? This isn't looking at comparable like rents from comparable properties.
Yeah, this is similar to what we were talking about on the T12 and how we're looking at, how's the property operating today? And this is really just breaking down what's the unit mix today. So this helps tell a story of, which units are the, most well occupied. It looks like on this property, it's, 94% occupied across the board, so it doesn't really seem to be an issue. There's a couple of those 1,117 units that seem to be a little bit lower in the occupancy, but overall, doesn't seem to be an issue here. The average in place rent is something that we're going to look at pretty extensively, because a lot of the deals that we're looking at, there's a value add story to it, where if you invest X number of dollars of CapEx on interiors, then you're going to get X number of rent bump. And then, it's good to look at comparable properties to do your rent comps, but really my favorite way to do rent comps is if, there's already a proven how value add plan on the property today. What are they getting on those upgraded rents versus the classic rents? And in this scenario, we've got 25 classic units at the bottom there shown, and 38 platinums. The platinums are 92% occupied, the classics are 100%. That doesn't seem too crazy there. Maybe the platinums are a little bit harder to lease because they're higher rent, or maybe they're just still down units, and they're in the process of getting them renovated to turn them into platinums. That's probably a little too detailed for this conversation, but really what I would focus on here is the average rent per occupied unit on the classics is only $1,700, versus the platinums around 1974. So you're getting a nice $270 premium by upgrading from a classic to a platinum. The premium finish on this property, it was a minor cosmetic upgrade, so really wouldn't focus too much on that one. The platinum is really what we try to drive home and essentially invest and come up with a CapEx plan that essentially matches that scope of the platinum unit. And then you get a nice return on your investment for that CapEx invested to get that higher rent. So this is, what we're going to do on every single deal. We're going to look at average in place rent. We're going to look at max in place rent. What's the max achieved rent on each unit type. And then digging into why some of these rents are higher versus the average in place. Sometimes it's a shorter lease, and they've charged a higher rent because it's a 6-month lease. Sometimes it's just a resident that, they were able to charge a higher rent. It's simply sometimes as simple as that. But we want to know all this stuff before we buy a deal, and it's going to go into our analysis and understand like how realistic are we being with our rent bumps, because that's going to drive your returns and story on the deal.
Yeah, and I think, for purpose of this call, we're running right at the hour here. This changes too when you're looking at a lease up, like an A-class deal where it's currently in lease up. It's hard to look at comparables there because they're just focused on getting people in the door, so you're looking more heavily on rent comparables, and your concessions hopefully start to burn off. So we are planning on doing another educational webinar after the holiday on how hedge funds look at, look at institutional type deals. So we'll be diving in more on that for one of these next webinars. This is a big important, don't want to gloss over that, but for the time, reserves funded at closing, you want to make sure that your reserves cover your downside scenarios. What happens if CapEx goes over? What happens if vacancy goes a little bit higher? Hopefully you're underwriting for that scenario. So we're looking at that, and that's you're looking at how much of reserves is funded at closing and how much of reserves are you putting aside each month. How much of your income are you putting aside to these scenarios? So that in this scenario, we're looking at, if it's a heavy cash flow, we can look at replenishing that from the cash flow. NOI growth over the hold. Here's a 7-year hold. We're looking at what the total revenue growth is, what the expense growth is, what that looks like annually. Annually, you're going to want to see 3 to 5% is pretty standard. Sometimes as low as 2, sometimes as high as 5. Unless there's some big value add plan, you want to be careful to go any higher than those numbers right there. But you can see right here just some slight changes. What's
Yeah,
the difference?
the only difference here is just the exit cap.
Exit cap.
Obviously, the exit cap typically drives the majority of returns on any real estate deal. We are trying to find deals that have less sale driven returns and more cash on cash. Although, it's great to have a great buy that you think you can exit at a great price, but we want high cash on cash day one, because one, your downside is very protected in that scenario. There's a lot of cash to go around and service your debt and pay distributions, and you're going to be able to invest back in the property as well. And in a slower market, you're not going to be a forced seller. Where we're kind of in that market right now where sellers want to sell their properties at a 5.5 cap, and we're trying to buy them at a 6+ cap. So you want to avoid being in that scenario, and if you have a high cash flow deal, then you can typically just push through that and wait for the market to recover for your benefit.
Here's another scenario there, looking at that cap rate. Here's sales comps. This is important, again, not glossing over.
Yeah, so this is essentially just looking at sale comps and basis. While this is definitely important, this just doesn't really affect your returns in a sense. This is more really helping us quantify like what the floor is on the market, where stuff is traded relative to where we're buying the property. So for this example, we're going to look at price per unit. We're going to look at price per net rentable square foot. We're going to look at cap rate, although typically don't care too much about that, because cap rates on every single deal are incredibly variable. Something that we'll also look at that I like a lot is the asking rent for the property versus the price per unit, and the asking rent on a square foot versus the net rentable square foot. So you want to be paying you want to be buying a property with a higher percentage in that scenario. You don't want to be paying a high price per square foot and a high price per unit when a property has low rents. It's a very basic understanding. You want to get more bang for your buck, so you want to be a higher percentage there. This is just something that we'll do on every deal, and it just, again, it helps quantify the floor and really helps you understand your market and where other stuff is traded.
Yeah, super important right here. Couple questions came in, so you guys have done a great job asking questions as we went through here. Guys, these sessions really do add a lot of value. Thanks so much for sharing your knowledge. I need to jump. Thank you, guys. Thank you for sharing. Have a good night. I don't know. I heard walk the neighborhood, do the boot work. So much is discovered physically being there. Yes, 100% walking the neighborhood, walking the comps, asking the leasing agents of comparable properties, how their leasing is going, what available units, acting as a potential resident, not acting as a potential buyer, but coming in as a prospective resident. Super important, when you're doing that boots on the ground. Where do you get your sales comp? Where do you get your sales comp? Someone asked.
Sale comps typically come from either the broker or, CoStar's got a lot of good sale comps, or sometimes, if it's public, if it's a public domain and the sales are published, you can just find the actual sale price on the tax records.
Are you guys primarily looking at assets with great year-over-year rent increase percentage? Says Nick, are you guys primarily looking at assets with great year-over-year rent increase?
I'm not sure I understand year over year, rent increase percentage. So basically, if their rent has increased a lot over the last year, are we gonna look at that? I mean, yeah, of course, it just, that's just something that we'd factor into our analysis, like, why are those rents increasing? Are they simply catching up to the market? Are they renovating units? Should we replicate that strategy, where they're executing that? Or I mean, something to be careful about sometimes on C-class stuff is they're pushing rents, but their bad debt's gonna increase as a result of that. So definitely, that's something that we're gonna look at, is how much have they pushed rents over the last year? Because that'll tell a story and where we think we can take it as well. How many comps do you typically look at per analysis? Yeah, this is probably overkill for the sale comps, but just wanted to kind of paint a picture here. I mean, really, sale comps, you probably need like, I don't know, 5 to 10 really good sale comps. You don't really need too many more than that. And really it's looking at, the recent sale comps is the most important thing, because obviously the market changes and we're in a much different market than we were in 2022. So finding recent sale comps is very important. And then digging into the actual transaction data and understanding, was this a 1031 buyer? Is that why the price per unit so high? Was this a, standard market rate transaction? Or was this an off-market deal? Was there some weird tax exemption included? There's a million different things that could happen why a sale is higher than it should be. And, we typically want to find out all that stuff out before we offer on the deal. But the brokers generally are able to have all this information. So they're very helpful with sale comps.
Charlie said, do you use any software or in-house master Excel file compiling all underwriting variables? Mina said, Nick's Brain is our software. Excel is pretty much what you use, right? You kind of,
Yeah, I mean, Excel, we've got, Mina's got it down. We've got our underwriting template down, and it's something that we built from scratch. So every deal is going to be different. All of our assumptions are going to be different on every deal. We're not going to be just throwing in a 10%, number just to call it a 10% number. We're really going to have a logical rationale behind our assumptions. And as far as compiling all these variables, I mean, we've got them all laid out in our underwriting template, so we can kind of plug away on it.
I need to become Nick 2.0. That's right. Partner with us and we got you covered. After the underwriting process is completed, how much of a discount can you expect based if performance value is lower than asking price?
Sorry.
After the underwriting process is completed, how much of a discount can you expect based if performance is lower than that? So hopefully you get the full picture before you've made your offer. You know, I think, Reggie, what you're asking about is maybe if you're doing your due diligence and the underwriting isn't quite what you thought. You know, hopefully you already have the full picture, so you're not asking for it. The biggest reasons why we find discounts after we've submitted a price or submitted an offer is based on physical due diligence. But sometimes it can happen for financial due diligence. We find out that renters aren't actually, they're actually not paying, you know, doing rent audits. Maybe the delinquency is higher than they reported. Sometimes the actual vacancy reported isn't as high, doing a lease audit. Some other things
Brian, I'm sorry, I'm reading that as in the underwriting process, so not due diligence. So just like if somebody's asking 100,000 per unit, and then you do the underwriting, and you think it should be priced at 80,000 per unit. How much of a discount can you expect? At least that's the way I'm reading it. And that's hard to say without knowing the seller situation. It could be somebody that doesn't need to sell, and they're just putting it out there to see if they can get the price they want. In that case, probably not much of a discount. But if they're in a pretty bad situation, and they happen to have some equity, you could probably get a pretty good discount, especially depending how long it's been on the market.
Yeah, stick to your underwriting. Just because they ask for an asking price doesn't mean you have to stay at that. You can ask for whatever discount you need based on what your underwriting is. But to George's
Yeah, and
point,
submit the offer. Doesn't matter if it's 50% of asking. I mean, I doubt you'll get that, but submit the offer and follow up. I mean, I know Nick just sent some follow-ups recently on some deals that we submitted offers on, and they had told us that they went under contract, but even then you want to follow up because so many things are not getting closed and getting to the finish line.
Yeah, asking prices are coming down each month, I would say. So just name of the game is just keep submitting offers, keep the finger on the pulse in the market, and don't overpay.
awesome. Well, appreciate the questions, guys. Very engaging. Looks like we have another webinar on the 10th of July. So next week, hopefully everyone is poolside, lakeside, watching fireworks somewhere, enjoying the reminder of why we are a free country, and celebrating the holiday. So we look forward to picking these webinars back up on the 10th. Hope you guys got some value. Feel free to email us with anything you need. info@elevatecig.com. We're happy to help you guys partner, invest with us. Questions about whether you're investing with us, investing with someone else, definitely want to be a resource. So appreciate everybody who's in our community here, and look forward to continuing to over deliver. And Mina put his personal email there in the chat too. He's 24/7.
Thank you all. Appreciate you showing up.
All right.
Sure.
Have a good night.